The dollar just spiked 1.8% in 72 hours. Gold dropped $60 per ounce. Silver fell 4.2%. Copper reversed a 3-week rally in 2 sessions. This wasn't a pullback. This was a coordinated macro event triggered by something most traders completely missed. If you're holding metals right now, or you've been waiting for a dip to enter, what happened this week is not noise. This is a structural shift that rewrites the next 6 months of this entire trade. And if you don't understand the mechanism behind it, you're going to get caught on the wrong side when it accelerates. Stay with me until the end because I'm going to show you the exact divergence I'm watching right now that tells me whether this is a temporary flush or the beginning of something much larger. I'm also going to walk through what the bulls are missing and what the bears are getting right. And then I'll tell you what I'm doing with my own positioning. But first, you need to understand why the dollar moves like this in the first place. Think of the dollar like the tide in a harbor. When the tide goes out, every boat in the water drops. When it comes in, they all rise. Gold, silver, copper, commodities in general, they're all boats in that harbor. The dollar doesn't just compete with metals, it inverts them. When dollar strength accelerates, it pulls liquidity out of commodity markets mechanically. Not because traders are bearish on gold, because holding dollars becomes more attractive than holding anything priced in dollars. Here's the number that matters. The DXY, the dollar index, broke above 108.5 this week. That's a level it hasn't held since November 2022, and back then, gold was trading at $1,650. Today, it's at $2,740 even after the drop. That gap is the entire story. Now here's where it gets interesting. This dollar move didn't happen because of some random headline. It happened because of a structural repricing in global interest rate expectations. And that repricing is still unfolding. The primary cause. The Federal Reserve is not cutting rates the way the market priced in 3 months ago. In December, the Fed funds futures market was pricing in 4 rate cuts by the end of 2025. As of this week, that number is down to 1.5 cuts. The market went from expecting 100 basis points of easing to expecting 35. That's a massive gap. And when rate cut expectations collapse, the dollar rallies. It rallies hard. Why? Because if U.S. rates stay higher for longer, global capital flows back into dollar-denominated assets. Treasuries become more attractive. The carry trade comes back online. And suddenly holding the dollar is not just safe, it's profitable. This is the mistake most people make. They think the Fed controls the dollar. The Fed influences it, but the market prices it. And right now, the market is repricing the entire 2025 rate path based on one thing: sticky inflation data that refuses to go away. Core PCE, the Fed's preferred inflation measure, came in at 2.8% year-over-year last month. That's higher than the previous quarter. Wage growth is still running above 4%. Services inflation is accelerating again. The Fed can't cut into that, and the market knows it. But this is the part nobody's talking about. The dollar's move this week wasn't just about the Fed. It was about Europe and China simultaneously weakening. The secondary cause and the precedent. The euro dropped to 1.02 against the dollar this week. That's the lowest level since November 2022. The Chinese yuan is testing 7.35. A level that triggers intervention concerns from the People's Bank of China. When both Europe and China weaken at the same time, the dollar becomes the only stable reserve currency left standing. And that creates a feedback loop. Strength begets strength. Capital flows accelerate. Commodities get crushed. We've seen this before. In 2014 and 2015, the dollar rallied 25% over 18 months. Gold fell from $1,300 to $1,050. Oil collapsed from $100 to $26. Emerging markets went into crisis mode. The entire commodity complex was dismantled. The setup today rhymes with that period in 3 specific ways. First, the Fed was tightening while the rest of the world was easing. Second, China's economy was slowing faster than expected. Third, there was a deflationary shock running through global supply chains. All three of those dynamics are active right now. Let me connect the dots. If the dollar continues this move and breaks above 110 on the DXY, metals face a technical and fundamental reset. The bull case for gold that dominated 2023 and 2024 was built on Fed cuts, geopolitical instability, and central bank buying. Two of those three pillars are still intact, but the rate cut pillar just fractured. And this changes everything. The bull case, the bear case, and the divergence. Here's what the bulls are saying. Central banks are still buying gold at record levels. Geopolitical risk is not priced in. The U.S. debt trajectory guarantees long-term dollar debasement. And gold has historically performed well even during periods of dollar strength if real rates stay negative. That case is not wrong. It's incomplete. Here's what the bears are saying. Real yields are rising. The 10-year Treasury inflation-protected security yield just crossed 2.3%, the highest since 2023. When real yields rise, gold loses its opportunity cost argument. The dollar is in a structural bull market that could last 12 to 18 months. And speculative positioning in metals is still elevated, which means there's room for more unwinding. I weight the bear case higher right now. Not because the bull thesis is broken, but because the time frame has shifted. Now here's the divergence I'm watching. Gold to silver ratio. It's currently at 94. Historically, when this ratio spikes above 95, it signals that the metals complex is in risk-off mode. Silver, the industrial metal, gets hit harder than gold during liquidity contractions. If we break above 95 and hold, that confirms the dollar move is not a head fake. The second indicator is copper. Copper is the most economically sensitive metal. It dropped 3.1% this week. If copper continues lower and breaks below $4.10 per pound, that tells me the market is pricing in a global demand slowdown, not just a dollar spike. Third signal, mining stocks. The GDX, the gold miners ETF, is down 8% this week, while gold is only down 2%. When miners underperform the metal, it's a leading indicator that institutional money is rotating out. All three of those signals are flashing caution right now. What I'm watching and the identity call. I am not selling my long-term gold position, but I am reducing speculative exposure to silver and copper until I see stabilization. What I'm watching is simple. If the DXY reverses below 106.5, that tells me the dollar rally was a short-term squeeze and the metals trade is still alive. If the DXY holds above 108 for 2 weeks, I expect another leg lower in metals, and I'll be sitting in cash waiting for a better entry. I'm also watching the Fed. If Powell shifts his language in the next FOMC meeting and signals that cuts are still on the table for mid-2025, that could reverse this entire move. But based on the current data, I don't see that happening. The real question is what kind of investor you are. If you're a long-term holder who bought gold as insurance against currency debasement and systemic risk, this pullback is noise. You don't sell. You might even add on weakness. If you're a tactical trader who bought metals because you thought the Fed was going to cut rates aggressively, you need to reassess. That thesis is on hold. The macro backdrop has shifted, and fighting the dollar when it's in a momentum move like this is how accounts get destroyed. If you're sitting in cash waiting for an entry, you don't chase this dip yet. You wait for confirmation. You wait for the DXY to peak, for real yields to stabilize, for miners to stop underperforming. Then you strike. Here's the thesis restated. The dollar spiked because rate cut expectations collapsed and Europe and China weakened simultaneously. That created a mechanical sell-off in metals that is not finished. The bull case for gold is intact long-term, but the time frame has extended. The next 6 months favor caution, not aggression. This is not the time to panic. But it's also not the time to ignore what's happening. If you found this breakdown valuable, share it with someone who's trying to make sense of this move. Drop a comment and tell me whether you're holding, selling, or waiting. And if you're not subscribed, do that now because this story is going to evolve fast, and I'll be covering every step. The macro environment just shifted. The question is whether you're positioned for what comes next. One more thing. There's a technical pattern forming on the gold chart that almost nobody is discussing. We just broke below the 50-day moving average for the first time since September. The last time that happened, gold dropped another 6% before finding support. If that pattern repeats, we're looking at gold testing $2,580 in the next 3 weeks. That's the level I'm watching. Because if we hold there, the bull market is still intact. If we break below it, we're entering a deeper correction that could last into Q2. Keep your eyes on that number.